Congratulations, everyone. We have been rescued by the Fed once again. Let's all celebrate because the wisest of the wise technocratic elite have raised interest rates by a fraction of a percent. Place your bets and take a seat. You came here for the truth, so let me unveil that for you. Today we are going to get into 4 charts that prove the Fed rate hike will slow the economy. And it doesn't take a genius to figure that out, but let's use the tools we have to make it even more reasonable and obvious to explain. Before I get into this, I want to show you this chart here, an infographic in fact. What you're seeing on the screen right now is derivatives, and I can't actually even zoom out to show you the whole thing. That's how big derivatives are when compared to some other things. I definitely recommend you check out the link for yourself so you can see it. Like I said, can't even show it on the one screen. So let me move through this here. As we go through just a comparison, gold, commercial real estate, these are tiny little blocks on the screen. On the right-hand side, it gives you the actual values. On the left-hand side, sort of a picture diagram. Now, look at the Fed's balance sheet. We know how massive it is. Compared to derivatives, it's nothing. And then we move up just a little bit. As you can see in the top there, we have Warren Buffett, Bill Gates, Carlos Slim, massive fortunes. But it's just one little tiny block. Look at Apple and Microsoft and everything. Compared to the Fed's balance sheet, obviously they're much smaller. Compared to derivatives, they're a fraction of that. What I'm trying to suggest here, among many things, is that when you take a small percentage number, like 0.25% on your mortgage rates, it may not be that significant. But what does that do to all the loans, all the leverage that is taking place with derivatives? I do believe that this has a significant impact. Perhaps that won't be today or tomorrow, might take a little while, but I do believe that this has impact not on the direct economy itself, although it does hurt. I believe that it has profound lasting effects all the way down the line, the ripple effect occurring. Now, let's move into this here. Withdrawals hit U.S. corporate bond funds. Investment-grade bond funds in the U.S. have been hit with a record wave of redemptions. That's selling. A week after 2 high-yield funds announced they would shutter and another barred withdrawals as the credit market showed further cracks. Investors withdrew $5 billion from U.S. mutual funds and exchange-traded funds purchasing investment-grade bonds, those rated BBB- or higher. Basically, what it's trying to say is we want something safer. What we can rely on here are bonds. Now, I think that's a terrible idea. That's what they're doing anyway. But they're basically selling off what they had before and getting into what they believe is safe. I think, obviously, they're going about this wrong. Second biggest weekly outflows from bank loans since August 2011. You can see the picture of this right here. Weekly flows as a percentage of the AUM. That's assets under management, and we're looking at it declining. We're not doing good right now. 2011, obviously, we had the European issues that were going on and really hurt the markets overall. Let's move on to what I show you in my book, a very, very simple diagram. All I'm saying here is that when you have the stock market, you have interest rates, they are always in an inverse relationship. Sure, there could be times when this doesn't really have an effect, but over the long term, when you look at fundamental analysis anyway, you have the stock market rising as interest rates decline. If interest rates were to increase, you have the stock market declining. Yes, you can print trillions of dollars and get it to come up, but that obviously is a factor. So just, of course, obviously being a very, very simplified version, but just something that will hit home for many. Both in the 1970s and the 2000s, the real federal funds rate was in the negative territory over long stretches of time, even when the nominal Fed funds rate was hiked. It often remained quite low or even negative in real terms. So you have to remember that, yes, they can show us numbers on the screen, but what does that do in terms of the actual real rates? Well, obviously, when you have levels of inflation, you are going to really change the reality of the situation. That's all I'm trying to mention with this chart. Let's move on. Here, as we look at the stress test, this is right from the St. Louis Fed. Forget about what the chart is showing. What I'm trying to tell you is that the stress tests are a big bunch of bull. Let's keep it family friendly. As we look at these stress tests, they said everything was good before the financial crisis. They said everything was good in Europe when they had their issues, between that 2011-2012 timeframe. How can you believe anything that they say now? It doesn't matter if it's the rating agencies doing this or banks or whoever. They're all false. U.S. short rates still at, quote, depression levels. U.S. government 90-day T-bills. Look at it today. Look at it during the Depression. We're talking about the same levels. But if you bring that up to people, they say you're a fearmonger, you're this and that. It's silly. Just look at the facts. In many, many ways, we've head back into the financial crisis. This is the financial crisis part 2. And here's a little funny diagram for you to look at. A rate hike may hurt the economy. The way I see this picture is that the dead economy has now fallen over the cliff. It's already dead. It's already beaten up and broken. And there it is, falling over the cliff. If you found this video informative, please give me a thumbs up. That really helps me to get my videos higher up on the YouTube searches. If you put a comment up there, just say thank you, say hi, say anything. It's going to get the videos to come up higher in the search results. So I really do appreciate that very much because it gets the word of truth out there. And you don't have to necessarily share it on your Facebook or anything like that. You can just give it a thumbs up, give it a comment. I appreciate that very much. If you found this video informative, I know you'll find my book, The Money GPS, even more informative. And you can actually look through the book. If you go over to Amazon, they have a look inside feature, which allows you to flip through the pages of the book and see if you like it. Take care.